Hey everyone, and welcome back to another episode of the Indie Investor Pod. And I am really excited to have Eddie Wilson on here with me today. I've got to know Eddie a little bit over the last couple of years, and the last time I got to get together with Eddie, he came into Indianapolis. He was sitting down with our team. We had a team meeting, and during our lunch break, our guy Ronnie just asked him, like, "Hey, if I had like $20,000, like, how would you start investing?" And then all of a sudden, Eddie took it and went into this. He had diagrams and all kinds of stuff on the board, and really just kind of taken into the active investing and the passive, and then portfolio and generational wealth and stuff. So I thought it would be great. This is episode 101 of the Indie Investor Pod. So it's just real estate investing 101. Like what should you do, and things like that. I know Eddie's got a lot of really good thoughts on this. So Eddie, really, I'm just going to kind of turn it over to you for a little bit. And if somebody was in that spot of like, they want to start investing and
Sure.
they really want that to be that's what they want to do. That's what they want to retire on, and, set up a legacy for their family and all that stuff. But, they're limited on funds, and maybe they only have about like $20,000. What would you really recommend for that person?
Sure. Yeah. It's interesting because, when Ronnie asked me that question, it's a question I've been asked so many times. I own the company Think Realty, and, we'll have close to 1 million people touch that platform. And interesting enough, the question I get more than anything is, how do I get started? Or how much money do I need to get started? Or how much should I save? A lot of people will kind of look at the Dave Ramsey method, and they'll save and they'll get their bills paid down. But it's like, then they get to the end, it's like, okay, now I'm living, debt free, but what do I do with the extra income I have? And for me, that's when I kind of jump into, my theory on how I believe Americans as a whole should take advantage of the opportunities we have in our country. I mean, we are so blessed to be able to live in a country where our real estate market has been robust since its beginning. It's never missed, any period of 7 years. We've never had a downturn. I mean, it's crazy what we live in, and to not take advantage of it when so many other people around the world don't have that advantage. It almost seems like a shame to me. So I kind of broke it down in a few ways for your guys, but let me kind of give you the big overview. So I believe that if you drew a circle, right, that it divides that circle into 3 pots. And I have what's called my active money. That kind of takes 1/3. And then I have what's called my passive money, and then my portfolio money. So it's broken down into 3 areas that all of my income, all of my money is broken down into. So let me just kind of describe those 3, and then let me talk to you about what maybe we can do with $20,000,
Perfect.
or even less in some circumstances.
Yep.
So, the first step is active. Like that is what you actively earn based on the trading of hours, right? So for me, I own businesses, and my active money comes from the businesses I own. Those businesses kick off cash, either through distributions or through paying me, a W-2 or a 1099, however you're structured in your business. But for the average person out there, it might just be their job. They might be doing 40, 50 hours a week, and that's their active money. I kind of, look at my life and I break it down by the time I have, not necessarily by the money I have. Time is a really important, asset to all of us, as we know. So I look at it and I go, I don't want to spend my entire life just trying to earn active money, because I have a finite amount of time in my lifetime. At one point, all of us will die. We'll all not be able to work at some point in our life. And so to think that we're always going to be able to earn active income is just not, likely. So, so my first bucket is active. But what I want to do is I want to take that active money and I want to put it into what I call passive investments. And so I want to put them in investments that take limited amounts of my time. If my most valuable asset or resource is time, then I don't want to go, most people, this is kind of how the American dream works. It's like we go get a job, 40-hour work week. We invest in a house. Then we start paying on that house. And then if we want to earn extra income, what we do is we go get a second job. We start a little side hustle. What we do is we just, again, trade more time for more money. For me, that's not what I want to do. I want to take my active time. I want to live on my lowest means possible, right? So that it's generating more income than, that's kind of the Dave Ramsey method, right? Like live well beneath your means. And so then pool that money and put it into what I call passive investments. And so for me, the strongest passive investment over the course of our nation's history has always been real estate. I'm a buy and hold guy. I want to hold my real estate as long as I possibly can. And the only reason I want to sell my real estate is so that I can use that money and go get more real estate. Like that's just who I am. Now, people in my world talk to me till they're blue in the face about cryptocurrency and the stock market and everything else, and I'm a visionary, so all that stuff has some interest to me, but it's never going to be something that I just dive into and start diverting my active income to it, because real estate has just been too predictable over the last essentially 3 centuries. And so for me, that's going into passive income. Then my passive income, it's going to start generating income. So like if I have rental units, for me, in the beginning, I had to manage my own rental units. Like I actually had to be the active, I did kind of give myself a job in the beginning. But the first thing I did in that passive side, in that passive 1/3, was try to figure out how to let everybody else do the work at that point. It's generating income. Let the income pay for the work so that I'm not trading, again, time for money. And then let it build. So that's the passive side. So then it's going to start kicking off. So let's say you have rental properties, and those rental properties net after you pay, property managers or, everybody to come out and cut the lawn or whatever you want to do. Let's say it's generating, a 10, 15, 20% more than, what you have in. So then I take that money and I roll that into what I call portfolio money. Portfolio money is where then I play in kind of the self-directed IRA space, my solo Roths, infinite banking, and all these other kind of crazy concepts that, I can get way, way too deep in, and probably did with your team that day as I started drawing everything out the board.
Yeah.
But
my question for you real quick on that is like, how did you know, like, what was your resource to be able to learn from how to go in from the passive to that portfolio, that kind of thing?
Sure. So, I grew up in a real estate family. I'm 3rd generation real estate investor. So it was actually pretty natural. It wasn't something I had to go learn on my own. I kind of got a lot of it through osmosis as a child. I mean, my dad had his businesses, but then I was out on the weekends helping him build duplexes or mowing the lawns or whatever it is. Like it was more osmosis. Like I am so blessed because I had a family that lived that. I didn't have to, I'm not a 1st generation real estate investor. I don't have to climb Mount Everest. I'm kind of, it's like somebody else climbed it, showed me the way, and now I get to climb it. So, and that's why I think so many people struggle today, is because they're looking at it as like it's Mount Everest, and it's like, but there's no tracks on the hill. They're like, okay, I want to get there, but I don't even know the path.
Yeah.
And so, I was luckily, now a lot of research, a lot of study, and a lot of failure too, right? I mean, there's been a lot of real estate deals that didn't go my way. And so, and I've had a lot of businesses that I invested in to try to create more active income that didn't necessarily pan out either. But then you get all the way around the circle, and then in my portfolio income, that can be businesses. Again, I have a lot of private equity investments. I sit on a lot of boards that have potential exits. There's a lot of stuff down in that portfolio bucket, but I don't necessarily play there in the beginning. If you kind of look at it on a timeline, it's really like you got to shore up your active income, right? Like you got to make sure you have money to play with on top. I really, yes, you can do no money down deals and you can go hustle and do all those things. But the reality of it is I think that those opportunities are few and far between today. And you're far better to just live on 60, 70, 80% of your means, save, 20, 30, 40%, and then you begin to put that into what I call passive. And so let me kind of architect just real quick what I look at. And so, and really quick, I know it's kind of hard maybe in a podcast, maybe somebody's driving down the road or whatever, to kind of absorb all this. You can get my book, which is called Time, Wealth, and Purpose by Eddie Wilson on Amazon. And in the back of that book, after I break down time, wealth, and purpose, I give exactly what I'm going to talk about here, which is just a quick roadmap on if all I had was $20,000. I think the roadmap shows you how to get to 20 million to, or I'm sorry, $20 or 20,000 to, I think it's like 5 million in net worth, or 1 million in net worth in 5 years, something like that. But you can kind of go through that book and look at that equation. It's real simple. I think the book's like $7 or $8 on Amazon. But so let me kind of walk you through that. So now that I have, let's say I've got $20,000, that was kind of the number you threw out.
Yeah.
And now I want to start creating the second 1/3, which is passive income. For me, that's rental properties, and it can be a single family, it can be a multifamily. I mean, I'm involved in single family, multifamily, commercial, hospitality, hotels. I've even invested in storage units. Like every asset class I mess around with, but only if it's going to yield me passive income. So I started off like just about everyone else did with rental properties. My first investment in real estate were duplexes. I loved the model. I was always scared of, like, I didn't have enough income, when I was early on. And it was like, what if, what if my tenant goes away, dies, decides not to pay? Well, a duplex felt a lot more secure because I had two tenants paying.
Yeah.
So like, it just made me feel a whole lot better in the beginning. So it was more of a risk aversion why I bought duplexes in the beginning. So I kind of started that way. But for me today, if you take Indianapolis, right, like that's where your base of listeners are. And, is it feasible? Let me ask you this. Is it feasible today to buy a house in Indianapolis for $100,000?
Yes, very easily.
Right. Now, it's probably feasible to do it at 80,000 or 60,000, right?
Yeah.
Like, I mean, there are deals out there. I know you guys are wholesalers. One of your businesses is wholesaling. And so you have access to properties at that price. And for me, there's so much lending out there. Let me give everybody a quick resource. If you go to the American Association of Private Lenders, the AAPL, American Association of Private Lenders, you can go on the member directory and you can look by state and look for private capital in your state, right? That's an easy one, right? Like you can go look there and there's probably going to be 10 or 15 private lenders that lend in the state of Indiana. And so, I want to make sure I give the resources as I'm kind of stepping down this path. So,
and I know they're there because I refer people to that, and I know that's where the private lenders are going. So yeah.
Quick plug. I mean, obviously that's another company I own, but that's what it's built for, is to try to give a resource to those people who are looking for private capital. And by the way, all the people that are in that company can't wait to give you their capital, right? Like that's their entire business model. So it's not like you're bugging them. They can't wait for you to call them. So you've got, let's say you kind of start with a wholesaler. You start with even the MLS in Indianapolis. I mean, I've owned and bought properties and had rental units in Indianapolis. So it's not like, I'm speaking without experience. And so you go out and let's say, at max, if you've got 20,000, you're probably looking for around $100,000 home, right? Like that's probably the max. You're probably going to have to put down, 15, 20% in the beginning. But with these private money lenders, what they'll do is if there's a small rehab attached to these properties, right? Like, and if I were a very first time investor, I don't know that I would go do a rehab heavy property. I'd probably look what we call in our world a kind of a wholesale deal, right? Like where it's just kind of a little bit of lipstick, a little bit of paint, maybe some carpet or something like that. But you don't want to have to change the bones of the property in your first deal. But take that money, and if you go to a private lender, oftentimes they're going to allow you to leverage that property for what they call their ARV, right? Like their after repair value. And you're probably going to be able to use your cash to do any of the repairs on the property. And then you can turn around and you can go get a mortgage on that property, a conventional loan once that property is fixed up and ready for the market, right? And then, you're going to then rent that property out. But the hope is that you've created equity in this property, right? And so this is kind of the deal in the book. It's like, let's say if you've got $100,000 house and you put $20,000 down, just simple numbers. So now you've got an $80,000 house. Well, hopefully if you've rehabbed or increased that and you've put a renter in it, in the Indianapolis market, it's not unreasonable to think that you can potentially leverage that for 120, 140,000. Yep. Now, this is kind of the slow model, right? Like this is the slow model. This is building wealth one unit at a time. I'm going to give you the slow model. I'm going to give you the quick model. So the slow model is then you leverage that property and then you go do it again. Like it's just rinse and repeat. And you do it to whatever degree your cash can sustain it. Now, I always tell first-time investors, put 20% of your net your net operating expense for that property in the bank before you go buy something else, right? Like make sure you're covered. Don't put yourself in a situation where you're creating more liability for you because if the renter doesn't pay rent, you don't want to be stressed out. Make sure there's enough capital there that you can pay the rent on their behalf, right? You can make sure that the bank is made whole. And so, because the bank, I look at the bank or these private lenders as just a partner in my deal. So So then it's just one at a time. And then, over 5, 10 years, I mean, it's very easy to think that you could get to 10, 15, 20, 30 houses pretty easily if you just follow that method, right? But that's kind of the slow method. Most people I talk to are like, how do I get to a net worth of $1 million, in 5 years or 3 years or 4 years? And for me, it's about generating more capital. So again, the more active money you have, the more passive money you create, right? Like it's a very simple equation. And so what I would do is if you want to speed that process up is go look for those more cosmetic flips. Go out, take the $20,000 you have, go get a private loan, make sure that you're set and ready to go, buy a property off a wholesaler, do a small cosmetic rehab and put it on the retail market. And you do that typically 4 or 5 times. And now you've actually got enough cash that you could potentially do 4 or 5 rentals at a time. And so that just speeds up the process. If you're willing to part with those properties, then you can potentially get more. Now, right now, you know as well as I do that the retail market is hot as can be right now, and it probably will stay hot for another 15 to 18 months. We don't see a big downturn coming unless maybe the Federal Reserve increases interest rates or something like that, because there's not enough, there's too much demand and not enough supply. And so I don't feel like it's taking on liability by flipping houses right now. I really feel like this is still the seller's market. And so I should be taking advantage of those retail opportunities. So if somebody wanted to go build $1 million in net worth, they easily could do it in 2 to 3 years by doing exactly what I just said, with starting with $20,000. Like I think most people think, well, I got to have 100 or 200 or 300. That's just not the case. These private lenders are out there. They're super easy to work with, and they will let you leverage that money, and then you're set to go.
Yeah. So no, that's awesome stuff, man. I love it. So I know myself and my guys are all fired up and stuff, just like listening to you talk about that and how realistic it really is, especially when you're in a market like Indianapolis, because you're not going to have, granted, you don't have that huge appreciation, but you also don't have that huge depreciation if something happens, or it's going to stay pretty level. And that's one of the things I love about Indianapolis and what makes it work so well and things.
And it's why the biggest hedge funds in the world have looked at Indianapolis,
right?
Rental income, the cash flow side. It doesn't have those super highs and lows, so it doesn't create liability for them, but it's a great cash flow market. If I was living in Indianapolis, you better believe I'd be putting together 100, 200, home portfolio, because I mean, it's just a very, very good rental market.
Yeah. So, and then on that note too, of like, then kind of taking it to that next step of like kind of turning that into that portfolio and kind of that next step and things like that. So what's that first step when you get there? So you get to that point of like, okay, and within 5 years, I have, $1 million, or I'm worth, net worth of $1 million. Now what do I do? Like, how do I get to that next step then from there?
I really think that everybody should consider a self-directed IRA account. Yeah. If you own your own business, go get a solo Roth. If not, just self-direct your income, your income for retirement into that account and begin to invest in real estate out of that. That's, to me, the very first step. You got to go have the vehicle to play inside of the portfolio income. Like if you don't have the vehicle, you're not able to play the game. Yeah. Then there's lots of vehicles inside of the portfolio quadrant, or third. And so number one is those self-directed IRA accounts. Number two is infinite banking. You can buy whole life policies. I talked a little bit about that with your guys. These whole life policies, you can borrow against them. Like there's lots of liquidity. And there's books on the infinite banking system. Like I would encourage anybody that's like thinking that way, go get a book on the infinite banking system. It's a little bit complex. It's a little bit over most people's heads. But it is an incredible, incredible tool for wealth building for future generations. Then you can get deep into learning about ROBs, rollover banking. You can get into family pension plans. I mean, you can get into some really, really deep stuff. But I would say to get started, start looking at a self-directed IRA account. So taking your 401k methodology, but instead of pointing those towards the Star Fund or other random, blue chip stocks, you're pointing it towards real estate. And then secondly, start learning about infinite banking. Infinite banking is a tool that I believe every American should consider once they started creating passive income.
Yeah, no, it was cool stuff. And I know you're talking about how your grandfather, who was a banker, right, in Cleveland, like kind of taught you, kind of grew up, like he taught you how to do this stuff and things like that. And it's just, some of that stuff just blew my mind. So yeah, getting into those resources and kind of tapping into that, I think is huge. Eddie, while I have you here and you got a couple minutes left on this, you mentioned it before, kind of like for what the market's doing right now, that it is a seller's market and it's going pretty strong. And you kind of see that for the next, 15 to 18 months. Do you have kind of a crystal ball? I know you don't have a crystal ball, but like kind of what's your forecast and like looking at it of like as real estate investors, especially in a market like Indianapolis, like what should, aside from flipping and just holding as much and then kind of creating that passive income, is there anything else that some people should be looking at or
Yeah.
considering that maybe they haven't thought about?
Let me just kind of break that down real quick. In 2008, 2009, 2010, we saw roughly 2.1 to 2.3 million foreclosures in the market due to the downturn. The one benefit of having Think Realty is I get to pull in all this data and I get to have all these amazing economists that come in and speak to our group. But they believe collectively that there's probably going to be about 700,000 foreclosures hit our market based on the moratoriums. All this kind of extending debt, letting the banks hold on to that debt. There's going to be, and let me just give you a quick for instance, because most people are like, well, I think the market's turning. Well, up until March of last year, we averaged 40,000 foreclosures that hit the market every single month, with consistency. Well, in March that got turned off, right? Because then, people could, claim forbearance, they could push their payments to the end of their loan, all of that stuff. Well, that 40,000 would have still kept going with or without the current crisis, right? That was just the rate. Mm-hmm. So now we're 15 months later, 16 months later, and that 40,000 has been pent up. That's pent up demand. So out of your 700,000, that 40,000 a month is sitting there ready. The dam is ready to break. Now, it's going to take another 12, 18 months for those to come onto the market. A bunch of banks are wanting to buy those. I don't think that there's a huge opportunity for those to come all the way back down to the investor through the traditional route. Here's where I see the opportunity. Today, the people that know that their house is going to be lost, they feel that impending doom, there's a good percentage of them that would just like an option now so they don't have to go through foreclosure. Yep. I think wholesaling right now is a great tool for a lot of people around the country. If they could target those people that are in distress, that know that impending doom is coming. And by the way, they're starting to feel it every month. It's coming. So it's intensifying. So they're ready for solutions now. And I know a lot of big wholesalers down in Florida and other areas have already turned their sights on marketing directly to that distressed buyer so that they don't have to go through the difficulty of foreclosure and, kind of the shame that you feel through all of that. And it gives them a solution that they can test. So if I were in, some of these hotter markets right now, I probably would be making sure that if I'm a flipper or if I'm, if I am flipping or I'm buying and holding, that I'm also kind of keeping my eye on the distressed seller market. Whether you wholesale those deals or whether you're just finding those at a low rate so you can flip them or put it in your portfolio, I just think that that's really where the opportunity is today. And then, kind of the second opportunity I see on the horizon is, the age of the millennial that's still living at home. We had this massive reverse last year where you've got almost 30% of all millennials living at home today, where it was at less than 20% pre-COVID. So you've had this massive increase of millennials that have been stuck at home for 15, 18, potentially 24 months that are going to be itching. Now, most of those millennials are in the workforce. They're earning good money. Yeah. And so while we kind of looked at that group for the longest time as like this group that we couldn't predict, I believe I can predict where they're going to be. They're going to be either renting properties, they're going to be buying properties in the next, that 10%. And now that 10% has gotten, that 30+% of millennials living at home have gotten a year or 2 years older. And they're feeling it. They want liberty. They want out from their parents' house. And I think there's going to be a massive influx of new buyers. Now, I can't predict what they want yet because we haven't seen any trends, right. But I do know that they're going to be buyers and they're going to be buyers soon.
Yeah. Yeah, they've had enough time, and they've been able to build up some cash as well. They've had that kind of on reserve and ready to make that move and stuff. So I really appreciate that, especially that part of that's what I've been seeing. That's what I've kind of been telling people too. That with the foreclosure stuff too, that it's whether it comes back to all of us in the end, I don't see that happening. But if you get ahead of it right now, I think is a really good position. So Eddie, thanks a lot, man. I really appreciate your time. Do you have any one last little tip or anything before we get out of here today? I'm just like, if you were starting off in basically real estate investing, what's one last thing maybe that you would do?
Yeah, last thing I would do is just educate myself. Every mistake I've made in real estate came from a lack of education or a lack of knowledge. And I'm not pointing people towards gurus or anything like that, but it's just get it, like I love local RIA groups. I love podcasts. I'm a part of, I think, 7 masterminds myself right now, because I think once you realize that this market is always changing, then you have to be ever learning. And so never feel like you've arrived. If you're a brand new person, don't feel bad about asking for help. We've all been there. And, educate yourself. And there's a lot of ways to do it.
Yeah, I love it. So, whether it's through reading, like through Think Realty stuff on their website, or, watching videos, whatever it may be, or getting yourself in the room with the right people you came back to, and I asked you before about how you went from passive to portfolio and how you learned about that. It's kind of, you said, I've been around it. I learned that. I'm in a position that wasn't me. I didn't learn that from my parents. So I need to educate myself. I need to be in those rooms. And that's a lot of people out there. So really appreciate that, Eddie. If somebody wants to just find out more information about anything that you have going on, or where to reach you or anything like that, where's the best place for them to go?
Yeah, so you can go to thinkrealty.com. That's the real estate investor site. If you have interest in the lending, American Association of Private Lenders. And then my personal website is EddieWilson.com, theeddiewilson.com. Being an Ohio State grad, I had to put the article "the" before my name. But anyways.
Love it. Go Bucks. So, and if you like coffee, definitely check out Because Coffee around the Atlanta area, right?
Right. Absolutely. Absolutely.
All right. If you need anything from me, don't hesitate to reach out. It's Brian@simplewholesaling.com. Let us know how we can help you out in any way. And with that, that's another episode of the Indie Investor Pod. Take care, guys.